So in this problem, we are going to work out the cash budget. So it is prepare a cash budget for each of the 4 months to October, indicating the month-end overdraft requirement. So the question also asks you, prepare the sales and budget and purchase budgets for the 4 months to October. So we don't need to work out the sales budget and purchase budget separately. It would be as part of the cash budget itself. So we can work it out here. We'll read out the first question. So Peter Black is considering the acquisition of an electronic business. Peter could finance the cost of furniture and fixtures 20,000, lease and property 30,000 from the sale of investments. He will, however, require substantial assistance from his firm, from his bank to finance the working capital. Before considering this facility, the bank requires information regarding expected profitability and liquidity. Peter has given you the following information. So he has given you what is the sales estimated. Okay. So cash and credit sales are given separately. July, August, September and October has been given. So the 4 months up to October are these. From July to October we have to prepare the budget. The average credit taken by customers is expected to be 2 months. So credit sales, the cash will be realized only in 2 months time. Bad debts are expected to be 1% of sale. So 1% of this amount would be bad debits. And the average gross profit percentage on sale is expected to be 25%. So out of the total sales, 25% is the profitability percentage. Inventory levels at the end of each month are planned to be sufficient to cover the following 2 months sales. So inventory has to be at the end of each month are planned to be sufficient to cover the following 2 months sales. Okay. So the inventory, the closing stock should be equal to the sales of the first month and the second month and the third month. So that would be put on the first month. Okay. Adequate supplies are to be purchased in July to meet this requirement. So there is no opening stock for in July for inventory levels. It is intended to settle purchases by the end of the following month in order to obtain a 2% cash discount. So this is where they are going to is going to be the purchase and the settlement of it. Expenses are estimated to be follows. So sales and distribution expense is 8% of sales. I think that should be like both sales put together. And administration and general expense are 2250 per month. The leasehold is 30 years and furniture and fixtures are expected to have a useful life of 10 years. So that's for depreciation calculation. We don't need to calculate depreciation for this sum. Depreciation is included in general expenses. Other expenses are paid as incurred. So depreciation has already been included in this 2250. So that has to be removed because depreciation is a non-cash expenses. So other expenses are paid as incurred. In the same month they pay it. Interest of 18% per annum is payable at the beginning of each month on the previous month's closing draft. So once we know what is the closing draft, the next month we pay the 18% interest. Okay. So that's about the problem here. So we can quickly start to work it out. So, so we'll start here. We can start with sales. So for sales, there are actually two elements. One is cash sales, another one is credit sales. So credit sales has 2 months credit. So opening cash is 0. So we can put the cash sales. Cash sales is 5, 8, 10 and 12. And credit sales is in 2 months time we will receive it. So the sale made on July will be received on September. So September amount would be 20, but not all the 20 we will receive. Only 99% we will receive it, because the balance is bad debits. So 20, and for August we'll get receive 24. So that's about the sales part. Let's get the other items. So I think that is the only total income there. So we'll go to the expense part. In expenses, we have purchase, so purchases will be paid in 1 month time. So I think we can't directly work it out. We have to work out put a working note for it. Working note 1, purchases. So we'll start here. So what they tell is that inventory levels at the end of each month are planned to be sufficient to cover the following 2 months sales. Okay, so the inventory level should be on the basis of the sales here. So we need to have the total sales number. So first we'll take the cash sale. On the credit sale, we'll total it first. So thereafter we can get the total sale. So cash sales is 5, 8, 10, 12. Credit sales is 20, 24, 30 and 36. So the total would be, okay, so this is the total of sales. So next is to find out what is the value of inventory. So gross profit, if you take gross profit would be 25% of this. So the balance is cost of sales. So cost of sales we can assume it to be inventory level, that we can assume that to be inventory. So cost of sales, we'll take it as the raw material value that has been sold. So if you take a trading account, okay, so this would be a credit item, this would be a credit item, and this would be the this would be a debit item. So both when you add, we get the sales amount. Now so this is the cost of sales that we have. So let's see. Inventory levels at the end of each month are planned to be sufficient to cover the following 2 months sales. Adequate supplies are to be purchased in July to meet this requirement. So if you see the closing inventory, should take into account the 2 months sale. So we can work out in reverse. See, the business is going to be continued, so inventory would be the same amount. So that's what he says. October onwards, it will be the same amount. So if you take November as well as December, the same numbers will get repeated. Okay, so it will be 36 of cost of sales that would have to be made. So we'll work out in reverse. So these two cost of sales should have been bought and kept in October. Okay, so it would be this number plus this number has to be in as closing inventory. So what about September? September would be these two amounts. Okay, these two amounts. In August, we should have inventory covering this, and in July, we should have inventory covering this, both these months. But we don't have any previous month before it, so we have to cover this also. We have to cover July's also. So July's actually opening inventory itself would be like a different amount. Okay, can't say opening inventory. So opening inventory, we have to purchase this also. So this would be our closing inventory. Now how much has to be purchased? That becomes a question. So purchase would be, we have to purchase for the first July. Okay, for July we have to purchase this as well as the next subsequent 2 months. Okay, so both we have to purchase and keep. So we have to purchase this as well as this. So this is what we have to purchase in July. But what about in August? In August, see, if you take July, we have already purchased up to September, we have purchased. So in August, all that we have to purchase is for up to the October. Okay, we have to purchase up to October because 2 months sale should be the inventory. So this would be the inventory. So thereafter it would be just 1 more month we have to additionally purchase. We don't need to purchase everything. So in the first month alone, we have to purchase the current month sale raw materials as well as August and September. But thereafter, as we have purchased for all the 3 months, thereafter it's just 1 month, then again a 1 month, then again a 1 month. So this would be the purchase. And when is the payment made? So it is intended to settle purchases by the end of the following month in order to obtain a 2% discount. So we can put it like this. It is purchase which is 1 month and they will get 98. So when will this will be settled? 1 month later it will be settled. So this number into 98 percentage will be paid in August. Subsequently, we can also work out for other months. Okay. So now we can copy this part and we can go here and we can paste the relevant numbers. So we have done. So the next item here, see from here on I think it's quite easy because see we can find out the expenses. So we have one expense called as the selling expense. So these expenses are paid in the same month. So 8% of sale. So again I don't think we can work out for so easily. So as we have work out working note, we'll just put working note 1. Okay, for this also we have to do a working note 2 we'll do. Why should we have a working note? We'll just see. See, we need the total sales. Without that, we can't work it out. So we have got the selling expense. On selling expenses, 8% of sale. It's 8% of sale. So we can work out like that for all the months. So done. Now we can copy this. So this is working note number 2. We'll just change that. So done. So what else we have? We have administration, which is 2250. From this 2250, we have depreciation. So we have to first remove the depreciation or else we can't work it out. So I think we have to do again a working note. Okay, so first we have to calculate, sorry, first we will put the expenses. So the amount is 2250. Then we'll calculate the depreciation on leasehold. See, that will be having a life of 30 years. And we have another one. So that is depreciation on furniture. So furniture has a life of 10 years. So we have to get the worth of it. So furniture is 20,000, lease is 30,000. We'll see once again. Furniture 20, lease 30. Furniture 20, lease is 30. So what is its worth? I think it will be 1,000, and that's per annum. And for furniture, it would be 2,000 per annum. See, we don't want per annum. We'll also have to get per month because these are per month numbers. So I think we'll work out total depreciation per year. Total depreciation per month. I think that we'll try to work out. So per year depreciation is 1000 plus 2000 divided by 12. That will give us an answer. So what is the answer we have to see? So that is 250 per month. So 250 we have to deduct from here. So depreciation or less depreciation. So every month it is 250. 250 have to reduce, and we'll get the adjusted admin expense. So that will be 2000. For all the months it's 2000. So we can copy this and we can paste it here. So that's done. So we can't put it as 2000. I think we'll put it as 2. So if you want, we'll adjust it in terms of 1000. It will be 2222. Okay. So what else we have? Depreciation is over. Selling is over. Interest of 18% per annum is payable at the beginning of each month on the previous month's closing draft. So only when there's a closing draft we have to find out that. I think we'll go to the end of the sum. So opening cash is 0. Total income would be sum of all these. Close it. Find out the total expense. So total expense would be sum of all these. And what's the closing cash? Closing cash would be total income minus total expense. Okay. So we have 1. So this 1 will be pulled here. Okay. So next, let's see for August what's happened. In August we have 9. We have 75. And what do we have as the closing cash? We have 66. So for 66 we have to pay interest. So interest, when do we pay it? Interest of 18% is payable at the beginning of each month on the previous month's closing draft. So interest will be paid. So that would be another item here. Overdraft interest. So overdraft interest is not paid in August. It would be paid in September. So in September, how much of interest we'll pay? We will pay of the deficit. The total deficit is this number. So we'll pay on that. So it would be 18%. So also, if you do this, we'll get a negative number. So negative number we should not have. We should get a positive number. So let's put a minus and check. And yes, we have the minus symbol has negated the other negative number. So this is the overdraft interest that we have to pay in the next month based upon the deficit. So now we can calculate the total expense. Sorry, we have to get the opening. So the opening again, the opening would be this number. So total income will be this, and total expense I think we have calculated. Just let's see whether we have calculated correctly. No, it has not taken correctly. Let's get the deficit. This is the deficit. So deficit also we got. Again, as it's a deficit, we will get we have to calculate interest also. So this is the interest that has to be paid. Let's get the opening number, total income. So total income is negative here also, and total expense is this, and total cash, closing cash would be this. Okay, so it is overdraft in all these years, so that can be an action. So the action is the company should get an overdraft in all these months. So that's about this sum. We'll move on to the next sum. So ensure that you understand the sum properly. The most complicated bit is the purchases. So once you understand that, the sum is like quite easy. So we'll move on to the next sum. So we'll start with this problem. So the required is complete the cash budget for each of the months January to March, year 5 for Quest company. Okay, for January to March only they've asked. So we'll start from the problem here. So the following budgeted statement of SOPL has been prepared for Questco for the 4 months Jan to April. So they have given us sales, cost of production, inventory, cost of sales, gross profit, administration and selling overheads, and finally net profit. And they have also given you some information. We'll go through all the information. So the informations are 40% of production cost relates to direct materials. So what is the production cost here? So this is the production cost. 40% of these represent direct material, and materials are bought in the month prior to the month in which they are used. So if they are going to use it in February, it's already bought in January. Purchases are paid for 1 month after purchase. So purchases will be paid in the next month. So goods are first purchased for February in Jan, and Jan amount will be paid in February. Okay, so typically the same amount is paid in the same month, but we don't need to look at those things now. 30% of the production cost relates to direct labor, which is paid for when it is used. So 30% again of all cost of production is direct labor, and it is paid in the same month itself. The remainder, so the remainder would be another 40% of the production cost is the production overheads. Okay, so the balance 40% is the production overheads, and out of those overheads, 5,000 is a fixed cost, which includes 3,000 depreciation. So 3,000 depreciation is a non-cash expense, so that we should not consider. So the fixed cost would not be 5, it would actually be only 2,000, because we should ignore the non-cash expense. Fixed production overheads costs are paid for when incurred. So the same 2000 will be paid in the same month. So what about the balance of the production overhead? The balance is 40%. The variable production overhead is paid 40% in the month of usage and balance in 1 month later. So that amount is paid 40% now and 60% later. The unpaid variable production overhead at the beginning of the month is 9,000. So the carried forward unpaid overhead is 9,000. So they tell about the sales. Sales are on credit. So all sales are on credit. 20% receivables are expected to be paid in the month of sale. So in the same month, the sale is going to be recovered, and the balance 80% in the following month. That is in the next month. So the unpaid trade receivables at the beginning of January is 44,000. That is, the 44,000 of cash will be collected in January itself. The company intends to purchase capital equipment costing 30,000 in February, which will be payable in March. So in March, we have to put 30,000. The bank balance on 1st January year 5 is expected to be 5,000 overdrawn. So it is a negative 5,000, not a positive 5,000. So we can work out the sum either in thousands or in full numbers. So we'll start. So we start with opening cash, then income, then total of the income, then expenses, then total of those expenses. So finally we get closing cash. So let's get each of these items. So we'll start from as per like what they have given. So the first item they have given is materials. So materials is 40% of these numbers. Okay. So we'll take a working note. So working note number 1 we'll take. So cost of production. So cost of production is 50, 55, 32.5. We don't need to do for April, so we'll just leave it. So 40% of it is direct material. So this amount, materials are bought in the month prior to the month in which they are used. So February amount, the number of this number 5522 is bought in January, and purchases are paid 1 month from 1 month after purchase. So whatever bought on January will be paid on February. That is, the same number will be in the same month. So that's what they are telling essentially. So you can work out the numbers like this. So we will now move on to labor. So labor also will have the same working note. So labor is 30% of cost of production. So out of this, 30% is paid. And they say which is paid for when it is used. So it is paid in the same month. So the next one is The remainder is production overheads. So we can find out is production overhead. So what is the balance? See, the balance is 40 and 30 is gone. So the balance would be another 30. So we can put it as balance itself, because that's how the sum has told us. So 50 minus 20 minus 15, it's 15, 16.5, 9.75. So this is a balance. This balance is split into two parts. So one is the fixed overhead, fixed, or else we can put it like this. So fixed is 5,000 in each month. Okay, but if you see here, fixed production overhead costs are paid for when it's incurred, but includes 3,000 of depreciation. So we can put it like this. We don't need to refer the working note. So 5 is the fixed production overhead, out of 3 is the depreciation. So we can put it as fixed cost minus depreciation. So that is the working. So thereafter we can find out what is the variable cost. I think we can put it as FC, this as VC. So what is the variable production cost? It says the remaining overhead is a variable. Okay, the remaining is out of 5, out of 15, 5 is fixed. So the balance is variable. Okay, so this is what is the production overhead, which is variable. And what he tells is the variable production overhead is 40% paid in the month of usage, and the balance is paid in the later month. So we could divide this number like this. Fixed production overhead. Okay, I think we'll cut short like production overhead VC will be paid as cash and also as 1 month. So 40% is paid as cash. Okay, 40% is paid as cash. The balance is paid as 1 month delay. So balance would be 10 minus the 4, 6, and then okay, 11.5 minus 4.6, 6.9 will be paid here. So we can copy both these and we can paste it. I think we've already copied the we'll paste it here. So these are coming from working note 1. Okay, done. So he says there is an unpaid production overhead at the beginning of January. So the unpaid will be paid in the, so all the subsequent months are being paid. So 9 would be paid in January. So January's 6 is paid in February. February 6.9 is paid in March. So December's number will be paid in January. So that's where we get this number. So what else we have still? So we have the admin and selling cost are paid quarterly in advance. On 1st Jan, April, July, or October, the amount payable is 15,000 per quarter. So the only month that falls here is the January 1. So on January 1, we have to pay 15. Admin overhead, we have to pay 15. Thereafter, we have all sales are on credit. 20% receivables are expected to be paid in the month of sale itself. 80% in the month following. Unpaid at the January. So the December credit is paid in January. That amount is 44. So first I think we'll take with the 44. So there are two sales. So this is cash sale and there is credit sale. That's cash sales and credit sale. So cash sales would be I think we need to put a working note here again. Working note 2. So first we'll put total sales. So total sales comes to in January it is 60. February it is 50. March it is 70. So the rules is the same month we get 20%. So the next month we get the balance 80%. Okay. So sales is, we can put like this. This is 20% of sale. This is 80% of sale and this is has a 1 month credit period. So we got these numbers. We can just copy them from here and we can paste it in this place. So the opening balance would be, the opening payables is 44. The company intends to purchase capital equipment costing 30,000 in February, which will be paid in March. So in March we have to pay 30. And finally we have the bank balance on 1st January is expected to be 5,000 overdraft. So overdraft is 5,000. So the total income would be the sum of all these numbers, and the total expense would be sum of all these expenses, and our closing cash should be total income minus total expenses. Okay, it is minus 14. Just let's check once whether we have left out any other number. Okay, I think we have done all the numbers. So the closing cash here will become the opening here, and again we'll find out the total income, we'll find out the total expense, we'll find out the closing here. So opening is minus 7.1, total income is this number. Okay, so that's about the problem here. We have got our answer. So hope you guys got an understanding here. So cash budgets are not like very very identical. They are like same, but we can't say they are identical. So each problem has its own unique kind of differences. This problem has like differences like we do all the working notes. Okay, from working notes we have taken the numbers above. So ensure that you understand the working notes, because understanding working notes is much more difficult than understanding the cash budget in this problem. So that's about this problem. We'll move on to the next one.